All right, good morning, everyone. We're going to get started here. Okay, U.S. markets traded kind of sideways in last night's session. A bit of a non-event. We kind of just keep pushing higher and then drifting out sideways and then pushing higher and drifting out sideways. That seems to kind of really be the pattern as of late. We're getting so late into the year now, a second to last week in November already. You're kind of getting the feeling that there's not much that's going to be able to stop us from the Christmas rally. I don't know if that's a bit of a booby trap here or what, but you kind of get that feeling right now from the markets. We've got tonight, if I'm not mistaken, we've got the release of the last Fed minutes. We had Yellen that came out yesterday and had comments saying that they'll continue to be easy conditions in the equity, in the monetary policy until such time as we get far through the threshold of employment, etc. So, I think that of some of the employment targets. So I think this is just more jargon out of the Fed that's just saying that things are going to be easy for a little bit longer. Didn't see much reaction out of that from markets, so obviously kind of priced in already. Like I said, we've got the FOMC meeting out tonight. We have the yen that continues to kind of track a little bit lower against the dollar and recent sessions, and really we've kind of broken out there on the technicals. I think maybe I'll show that chart in just a little bit. I was looking at it this morning. Things are looking good for the dollar against the yen on that chart. If we look at corporate action this morning, we've got we had Woolies that was out with a 20-week trading update. Some interesting numbers here. Clothing was up 11%. Food up 16.7%. It seems quite big. The number that stuck out to me was the sales in Australia and New Zealand, which were up 51% in Aussie dollar terms. That's I think quite impressive. Like I said, I don't know what the expectations were, but it just seems huge. The debtors book is up 15.4%. I think and the annual impairment rate was up 5%, which may be a bit of a concern versus 3% previously. So just keep an eye out for that in the trading this morning on Woolies. And we had earnings this morning, full year numbers out of Tiger Brands. They came out, they missed on the headline earnings per share number, on the consensus of Bloomberg there. 17.21 was the estimate, came in at 16.24. And then the revenue number we were expecting a little bit higher as well at 27.29. It came in at 27. Divi per share also looks like a bit of a miss. From 580 expected down to 555 is what we've got. So, I haven't seen anything that much more recent here, but the consensus, where the consensus estimates were for Bloomberg, it definitely looks like a little bit of a miss there on Tiger Brands. And we also had third quarter numbers out of Goldfields, which came in on a miss on headline earnings per share and the revenue per share. You can see there that's obviously a miss. So that's against Bloomberg numbers, but the guidance that they put out here on their cash cost numbers and the NCE numbers, they actually beat. So it's interesting that the consensus for Bloomberg was higher than what Goldfields had guided itself. It's hard to kind of miss revenue and earnings per share number when your production comes out in line there, and then your cash costs and NCE costs are better. But we're looking at two different sets of numbers there. We're looking at from the production and the cash cost and the NCE numbers. Those are the Goldfields numbers, not analyst numbers. So I think that's important to recognize there. They also maintain their 2013 output forecast at 1.8 to 1.9 million ounces. So I think that's important also. I don't think that it'll be taken as hugely negative, especially considering some of the previous jargon out of Goldfields. All right. This morning we have quite a bit of market data out today. We have trade balance numbers out of Japan, which were worse than expected. We have year-on-year export and import numbers that both look better than expected. We've got German PPI, SA CPI, UK Bank of England's going to release this Monetary Policy Committee meeting minutes. We've got NBA mortgage apps in the States later, retail sales out the States, CPI out the States, existing home sales, and then like we've got Bullard that's speaking on the economy later in Chicago, and then like we said earlier, the release of the minutes from the previous FOMC meeting, which I think is going to be somewhat significant. So quite a bit of market data out today. We'll see how that plays out. Let's jump into the maps. Okay, just out of intro, we were just talking about that U.S. dollar, Japanese yen chart. Let's just have a quick look at that out of interest. We'll back out into a 2-year here, and you can really see that we really broke out recently here, just above 99, and kind of a nice little wedge pattern here. So we've broken out nicely to the upside. I think significant upside here, possibly all the way up to a 105 level in the yen. One of the things I wanted to look at this morning in currency land here is this is the U.S. dollar ZAR. And just, we had a couple things that were out yesterday. There was a really ESCOM came out with its crisis warning, saying that it's its worst point since 2008, and then also there was a very bearish article put out by one of the big investment banks on South Africa yesterday. I'm trying to think exactly who that was. Anyway, bottom line is we had hold on, I've got it right here. It was put out by Brown Brothers Harriman. And there's some really really bearish points in the analysis there that they put out, very contrary, I think, to the recent thing that Goldman Sachs did, the 20 years of freedom. And I think what's really important is that they kind of set the stage for between the way that we're running deficits at the moment and the current outlook for growth, the inflation issues, etc. The outlook for the rand is quite bearish. Strictly fundamentally, they make the case that there's very little chance that they can see any way that the rand could strengthen over the near term, and they see significant downside on the near-term horizon. I think when you take that into context and you look at this chart and you look at where we are, this sort of levels at about 1035, 1040 here. Which is massive resistance here on the dollar against the rand, and if we get through this level, I mean, guys, technically this is just, it's going to implode, and I think that there's probably a lot of people globally that are going to be looking at this chart that will be punting the rand, that can be involved here. I just think it's really important for us all to realize how big of a level this is, and that if we get through this level over the next anytime over the next 3 to 6 months, what it's going to do to our equity market is going to be detrimental. I think detrimental to certain shares. Obviously, give certain, the dual listeds and even some of the mining stocks an incredible boost. So this is very important. It may be a big place that you kind of see funds that start to position themselves for. So just really be cognizant of this chart. We'll stay on this, but just keep this in the back of your mind. I think this is going to be a huge thing. On the back of that, I'll throw out this chart, which is, to me, I didn't buy it yesterday, and I'm kicking myself the whole time. I'm another nice bounce off this level here at 210. It's 2 out of the last 3 or 4 days, so we've tested it, and that's Billiton's. We have this nice breakout, and remember this chart, if you go back longer term, also is you can see how big this level is. Sorry, I think we can even go back to maybe I call it a 10-year weekly. You can see we've really kind of broken out here on Billiton's from this level, and I think that we're kind of getting this chance to test it. This was obviously one that'll fit in well to the weakening rand scenario. Should do incredibly well, and I think this level at 310, if we can get it down around close to there again, probably a great opportunity to have a nibble. Tiger Brands, I just wanted to show it this morning. Obviously, we've got earnings, throwing it out there again. The 305 level is massive. I would expect it to come lower this morning on the back of those earnings, but we popped up out of this range yesterday, and I think we'll have to see how this plays out, but just keep this in mind, sort of 291 to 305 is a range. We'll see how earnings affect it this morning. Barlow's is another one. We looked at this 20 times over the past however many days or since the earnings have come out, but I just wanted to show that chart there again on a closing basis. If you're a wick guy, we can look at it here. Either way, sort of somewhere between 100 and 101, somewhere there, either over 100 or 101 if you're looking at a closing basis or intraday basis. It's definitely a breakout on Barlow's, and it's kind of shaping up like it can make that play. I just don't want us to forget about it if we do pop above that. And then the last one I want to show actually is Foschini. The reason why I want to show this is we're starting to look a little bit head and shoulders here in Foschini. I know we haven't, the right shoulder is kind of a little bit limp there, but all in the same theme. With what's happening with the rand. I mean, to me, this rand feels like it's consolidating for another break lower. Fundamentally, it doesn't look right. Technically, it doesn't look right. It's terrible for retailers, obviously, especially the clothing retailers. And we know the massive level here is about 102.80 to 103, somewhere in that range. And I think if we drop that level, especially if we can spend a couple more days moving out to the right here, and we drop this level, I think it's definitely setting up for quite a bearish chart and a hell of a lot lower target, at least down to the lows of the year, potentially out of Foschini. So just watch these closely, guys. I think specifically that with this rand, what it can do, it's going to have a huge effect, obviously negative effect on our retailers, and probably a positive effect on some of the others. That's it for today, guys. Thanks a lot.